Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for being with us today. Today we're going to talk about the industrial real estate market in the U.S. Please welcome my first guest. It's Rene Circ. He's Director of Research with PPR, a CoStar company. Rene, thanks for joining us today.
Thanks for having me. Always fun to be here.
Well, we appreciate it. And let's talk about the 2014 performance to get us started. It seemed like the industrial industry really ramped up. How did it perform in 2014?
2014 was actually, I would say, an interesting year. On the one hand, the market truly could not be healthier. We track the investable market, the non-manufacturing market, and vacancies in that market contracted by 60 basis points to 6.8 percentage points. So this is an extremely healthy reading, a reading we haven't seen for at least 15 years. It's just all good. Now, the interesting part comes in on the demand side. The demand was actually just okay. In fact, year over year, demand was down about 3%. It came to about 159 million square feet. Now, this is very important because I don't want your listeners to read this into it as there was actually something bad happening in the market or there was some sort of a weakness in the market. That's not the case at all. In fact, what we are starting to see is that there just isn't enough quality vacant space on the market. In fact, there's so little of it that if we had two strong quarters, all of it could be absorbed. And so we believe that is actually what is holding back demand. So it's not a weakness, it's the availability of space. And to prove this to you, how about I throw out some rent growth numbers? Last year we saw rent growth in industrial at 4.7%. A, that's extremely strong, but B, even more interestingly, that beat out the office market by about 100 basis points and the apartment market by about 150 basis points. And you just don't see this every day.
Oh, that's fantastic. So I guess the industrial market is the sexy sector right now. And you talked about the demand for space and there not being enough space out there. So where are we on new supply as construction starting to ramp up?
So that's a story of two segments. Overall, construction is still relatively weak. I mean, what we delivered last year, just over 100 million square feet, is about 80 million square feet less than what the vacancies that I just mentioned could actually justify. So from that perspective, it's not really strong. Now, if you take the market and you try to look at it from two different perspectives, there is the logistics segment. There, the construction is a lot closer to what it sort of could be or should be. At the end of last quarter, we saw about 116 million square feet under construction, and that's maybe 5-6 million short to what we were seeing in 2005, 6, 7. So that's actually a pretty good reading. All of that shortage comes in that light industrial segment. There, it's literally we are delivering 1-2 million square feet per quarter. We are at least 40-50 million square feet short. And that is the market that has still needed a little bit of recovery to see more of construction because rents were depressed and price per pound was depressed. But the way we are looking at it now, by the end of this year, actually 2015, by the end of this year, we'll start those numbers turning around and that construction picking up as well.
We're talking with Rene Circ with CoStar about the industrial market. And Rene, this demand from these tenants and this absorption, is it mainly in the larger users or is it mid-sized user or is it a mixed bag? Where are these tenants coming from?
So from that perspective, it has finally, in 2014, it's been the story pretty much most of the year, but it's finally shifted to the smaller tenants. So the big tenants are still doing okay. If you look at demand from a geographic perspective, the market you would expect, Inland Empire, Atlanta, Dallas, and Chicago, in fact, in that order, they came in last year. So the big boxes are healthy, they are doing well. But what gives me most comfort is the fact that the smaller tenants, the light industrial buildings, are now seeing actually greater velocity than we are seeing in the bigger segment. And the reason why I like that is because if you think about who those tenants are, it's the housing sector, it's the manufacturers, it's the mom and pop, it's the local economy. And those companies, they don't have international exposure, they don't have huge lines of credit. If they are taking space, if they are growing, that's actually really good for the U.S. economy. That really gives me comfort thinking 2015 will actually be a good year because the growth is strong and the growth is widespread.
Yeah, I mean, I feel better just sitting here at the moment, hearing that.
Good.
That is good news. Well, what about 2015? What's in store for rates and absorption and vacancy? What do you think is going to happen?
Well, we feel that 2015 is going to be sort of a transition year. We've seen 15, 16 consecutive quarters of improving occupancies and decreasing vacancies. This year, we are forecasting only about 20 basis points decline in vacancies. And by the end of the year, we do expect that construction will come back and will start to slowly outpace demand. But once again, now we are talking vacancies, closer to 6.5% for the overall market and maybe 7.5% for the logistics market, which is very, very healthy. So that's really not a problem. Now, in terms of rent growth, we do expect it to be a little bit slower than last year, only because last year was just so strong. We are forecasting a little over 3% rent growth, which is still at least 100 basis points stronger than inflation, maybe 150. And as much as 3 times the long-term trend line of rent, or the long-term trend growth of rent in industrial. So still a good year, but I would say that the party is maybe not over, but it's going to turn into work.
Okay, so 3% is what you said, right?
3% of rent.
Okay,
Yeah.
all right. Well, great. Is there more demand and expectations for growth in the industrial market in certain sectors or in certain geographics of the U.S.? Where are the opportunities?
Well, we definitely expect that the logical places will do well. There are two interesting areas. One is on the positive side, one is on the negative side. On the positive side, we are seeing a lot of interest in the Pennsylvania corridor. As that consumption zone continues to be strong and more containers come that way, Lehigh Valley, Harrisburg, those are actually markets where we do see a lot of construction. But it is very justified. They are playing the big box market is a great idea. On the negative side of the equation is Houston. We are getting very concerned about Houston. As you very well know, the oil prices are down 50%. And the biggest concern there is that we don't necessarily expect demand to turn negative. We expect it to be more flattish, if that's the word, this year. But the problem is that developers are building as if that GMP was running at 6% growth rate, which we saw over the last couple of years. And we expect it to be locked closer to 0 to 1%. And so that market is getting overbuilt, and it's going to be one definitely to watch for 2015.
Okay, and let's jump to investment sales. What is this robust industrial market doing for cap rates? What are trends there in the industrial sector?
Well, capital flowing, at least 10% year over year up last year. So that has definitely continued to have a lowering pressure on cap rates. The best cap rates are now, we've been seeing sub-4 cap rates, which for industrial is just unbelievable. And we don't really expect this to change. If you think about spreads and if you think about the world as a whole, there aren't a lot of places where large institutions can place their capital. So commercial real estate in general in the U.S. and industrial specifically very, very healthy. So we expect cap rates to remain at these levels. Now, what we do see, though, is we do see capital flowing into secondary and tertiary markets, and we do see a lot more capital flowing into the light industrial segment. So I'm not convinced yet that's a choice. I'm more thinking right now that that's a necessity. There just aren't a lot of sellers, and since there isn't a lot of construction, we are missing at least 10 percentage points of sales volume because those buildings don't exist. They were not built. So investors are being pushed a little bit out on the risk spectrum, and we'll definitely continue more of that in 2015.
Yeah, and that makes sense, and I guess that's part of what's driving down these cap rates. Well, Rene, what in the numbers might surprise people about the industrial market today?
Well, I mean, there isn't one single surprise. I mean, it's just extremely healthy. If you look at the logistics segment, vacancies right now are 120 basis points below where they were at the best reading of the last entire cycle. So this slow growth has actually been extremely healthy for industrial, essentially for all commercial asset classes. And that has made industrial a very desirable class. I mean, what we are really seeing out there is that there are more and more investors telling us that they are under-allocated to industrial. And we are starting to see foreign capital, think of that in-store transactions,
All right.
flowing into industrial. And that's really not something that happened the last cycle around.
That's good news, Rene. Thanks for joining us. For more from Rene, visit CoStar.com. I'm Michael Bull. This is the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's RealNex. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit Xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.